Good morning, everyone, and welcome to the BetaShares Spotlight webinar, Sticker Shock, How to Position Portfolios When Inflation is Rising. My name is Chris Yates. I'm one of the directors over here at BetaShares on the advisor service and business side, and welcome everyone for joining us today. Inflation, it's on everyone's mind. We see it in the news every day, and we're here with David Bassanese to see how you can better position portfolios to take advantage of that. Before we go on,
how come? What happened? I thought it was on mute.
It was. I pressed it down.
Why don't we use this now?
It is being. We are using it.
Start again, sorry.
All right, whenever.
Welcome everyone to the BetaShares Spotlight webinar, Sticker Shock, How to Position Portfolios When Inflation is Rising. My name's Chris Yates. I'm one of the directors over here at BetaShares, and welcome everyone for joining us today. Things to consider just before we get along with the webinar. Obviously, some key things in here. Past performance is not indicative of future performance, and anything said today in the webinar is general advice in nature and does not take into account anyone's personal circumstances. The webinar today will be recorded, so you will get a copy of this at the end of the webinar, just in case you do miss anything or want to go back on any of the topics covered today. And as always, there's that little widget box down on the right-hand side where you can write your questions, as we will have some time at the end to cover those with myself and David. In terms of support material and content, if you jump onto our website, betashares.com.au, you'll find a stack of content to help you, and also you can subscribe to a number of different information emails like David Bassanese Spites, which come out every Monday, investment trends, and also jump on our social media either through Facebook, LinkedIn, and Twitter there. In terms of BetaShares, a quick update on BetaShares. We have over 63 funds now for Australian investors available on the ASX, and we have now just over $18 billion as of last week. So fantastic support, and thank you everyone that's on this webinar today for your support and taking the time to review and select our ETFs. And again, the genesis of having those ETFs is really bringing maximum value to you as the Australian investor. Join with me today. We're very lucky to have our Chief Economist here at BetaShares, David Bassanese. David is responsible in developing economic insights and portfolio construction strategies. He is also the chair of our investment committee for our own dynamically adjusted SMAs, which the asset allocation for those also play a part in those listed diversified funds and ethical funds as well. David's background, he was a columnist at the Australian Financial Review, the AFR. He was also a senior economist and interest rate strategist at Bankers Trust and Macquarie Bank, and also Treasury and OECD economist. And also, on top of all that, he wrote a book as well. So he is a very busy man, but thank you for joining us today, David. He'll be covering positioning those portfolios and giving you a broad economic update. David, over to you, mate.
Thanks very much, Chris, and great to be with you all again today for this Spotlight webinar. Very obviously, as Chris mentioned, an area that's very high on the radar, many investors at the moment. As you can see from this slide here, just an example of a number of headlines that have come up over recent months. Inflation is the big concern, and there is actually very good grounds to be somewhat concerned about inflation. Certainly over the last few months, it's picked up, as I'll be showing you in this webinar, in the United States. The big debate at the moment is how long it will last, and I guess a lot of what I'll be talking about today is areas that have done well in these rising inflation periods in the past, and may well continue and should do well to the extent these inflation concerns persist for a little while longer. But thereafter, I guess the question is, what's going to happen next year, the year after. That's, I think, where ultimately the bigger debate will be. But at the moment, this is certainly an area of the market that areas that are exposed to inflation are doing well and should continue to do pretty well. So if we just go to the next slide there. And again, I'll just give you the macro backdrop first before we look at some of the different investment exposures available. So firstly, the COVID situation. Go to the next slide there. And so this is, again, the new confirmed cases of COVID across the major regions of the developed world. I've got Europe, the United States, the UK, Australia down there as well. As you see, on a per capita basis, Europe, the US had major waves of COVID through last year. The good news is that they seem to be coming out of the last great big waves. Still uncomfortably high in Europe, but even Europe is starting to reopen as the pressure on the hospital systems ease. The United States, as you can see, it hasn't gone away, COVID, but it's certainly the rate of cases is well below the peaks that we saw only a few months ago. If you go to the next slide, not only is they're getting, and one of the reasons that I think they're getting on top of it, and one of the reasons like a renewed major waves seem to be, less likely now, is that we are getting the vaccine rollout. I mean, obviously a big debate in Australia about whether we're rolling them out fast enough. I mean, at least at the moment, the pressure to roll them out here isn't as great because, we did get COVID under control. But if you look at the US and the UK, where they did have major problems last year, the rollout has actually proceeded pretty well, actually, faster than many anticipated. So something like half the population in the US have now been fully vaccinated, and around 3/4 of the population have had at least their first jab, which is pretty good going. So that bodes well for the economy. So not only are we dealing with the vaccine, I mean, we've had, and again, for those that saw my recent economic presentation, some of these themes I did discuss there as well. So, but I just reiterate a couple of the highlights here. Is that not only is the US dealing with COVID, I mean, and the vaccines are rolling out, it had this extra stimulus that's really kicked in March with the Biden, the new President Biden. He did promise during the election campaign a $1.9 trillion stimulus package. And despite the economy improving, they did go ahead with it just a few months ago. And so as you can see here, this is a chart of household income, consumer spending, and the savings rate in green. So the blue line is income. As you can see, there's been a massive spike in household income with everybody getting, well, virtually all households getting like a $1,400 check. And much of that has gone out to spend. And if you look at the red line there, consumer spending has ticked up, but certainly nowhere near to the extent that income. So consumer spending is very strong, but it could have been even stronger given the boost in income. And as a result, the green line there is the household savings rate, which is spiked up. So that actually bodes well for growth going forward, because it means households are still cashed up, and they've got, because they haven't spent all of that stimulus money that's been given to them, and that will help support spending really over the remainder of this year. Just moving right along. We'll get into some of the slides in a minute. So look, what we've seen, of course, is an uptick in the inflation pressures in the US. So the chart there is the core CPI in blue in the first slide, and it's actually a dashed black line on the second slide. They're both, but similar. Actually, the two different measures of consumer inflation. So the first one is core CPI, consumer price inflation, even stripping out food and energy costs because they're seen as more volatile. But even stripping that out, you can see that the core measure, the annual rate, has gone from about 1.5% a few months ago up to 3%. So it's been quite a marked upturn. The core PCE measure, and again, since I put this chart together for this webinar, we've got an updated number, and that's also increased quite significantly up to 3% as well. So core underlying inflation in the US has spiked up to around 3% on an annual rate. And as you can see, the other indicator I've got there is from the small business survey in Australia, in the United States, and it's the percent of firms indicating that they're raising their prices. And so as you can see, there's been a big increase in companies raising their prices, which usually is a lead indicator of, pricing pressure coming through. If you look at, I mean, it's not a perfect one-to-one relationship, but generally when the number of firms that are raising prices has increased, you tend to see that flowing through to, as you would expect, to consumer price inflation over the next few months. So that is really the backdrop for why, and really what's happening. I mean, at the end of the day, the US has roared back. Demand is very, very strong. But I guess ultimately one of the issues here is that one of the reasons for inflation picking up is that production is still lagging. So we're seeing a so-called supply chain bottlenecks. Everybody's wanting to buy a car. Everyone's wanting to build a new home, but the raw materials needed to produce cars and homes, i.e., lumber and even computer chips, are finding it hard to keep up with demand at the moment, as they're sort of getting factories having been mothballed for much of last year, sort of re-gearing those up for production is taking some time. And so there's different bottlenecks along the supply chain, and as a result, we're seeing some pricing pressure emerge. Now, there's other stories also in terms of hotels, for example, have all jacked up their prices in one fell swoop in the 1 month with the reopening in the US, which has hit consumer prices. And so, depending on how long this lasts, I mean, you could see this pricing pressure persist. And what I haven't mentioned yet is wages growth. And the big question in the US in particular now is with the strong rebound and evidence of workers coming back to the labour force, but many are still not come back to the labour force, that you may see labour shortages and a pickup in wages pressures. Now, if that were to happen, then you get potentially second round inflation effects, and it could be somewhat more enduring. So that is the backdrop to the inflation pressures that we're seeing, and why obviously talk about inflation has picked up. Now, I'll give you some views about that inflation. Now, actually, there is definitely a risk that inflation does stay elevated for a while, and so the sort of inflation themes that I will talk about shortly, which have been doing well, may well continue to do well in this period that we're going through. So with that, let me just flick to the next slide. So not only that, I mean, the other, I guess, inflation issue in the United States in particular is that the central bank actually wants to see higher inflation. It's hard to read all those that text, but the bottom line of that text is that they have a new inflation target, whereas because inflation's been below 2% for so long in the US, the central bank is saying it actually is prepared to tolerate inflation above 2% for some time to make up for the low inflation they've had in the past. So this so-called inflation targeting, inflation average target is a sort of new talk coming out of the central bank. So we may see a situation where even if inflation does pick up, central banks may tolerate that for a while, not jack up interest rates, and as a result, we may see that inflation persist. Moving right along to the next slide. So what are the different investment exposures in this regard? So if we just go on to the next slide. So there's different ways. So basically what I've done here is break up the thematics in terms of global markets, different sectors, some that tend to do well in an inflationary environment and those that not do so well. And as you would expect, things like gold, fuel producers, energy, commodities do well. Banks also, funnily enough, tend to do well if higher inflation is also associated with rising interest rates, bond yields, because the net interest margins of banks globally tends to widen when bond yields lift, because they've got a pool of deposits not paying much interest, and they can then lend out at a higher rate. And their net interest margins widen, they tend to do well. So as you'll see, banks have been one of the areas of the market globally that have done particularly well in recent months. Now, one obvious area that doesn't do well in a rising interest rate, rising inflation area is technology, which sounds funny. And when I say technology, I'm not talking necessarily about the Googles, the Amazons, the Facebooks, though they are being affected, because they are companies that do have quite strong earnings capacity and even pricing power. But typically when people talk about technology, talk about growth, we're talking about companies that don't have a lot of current earnings, but they have this future expectation of earnings that are built into their share price. And so basically when interest rates rise, inflation rises, you discount that future earnings because it's not earnings they're delivering now, but they're going to deliver maybe 5 or 10 years down the track. The discount you apply to that goes up, and so they're more sensitive. Their valuations are more sensitive to interest rates because of the fact that earnings are still some way away into the future. And that's why the generally growth in technology stocks are the areas that are negatively affected by rising rates. So these are different inflation exposure. Again, so BetaShares, as Chris mentioned, we have over 60 different ETFs now, and some of which, they provide exposure to lots of different thematics. And what I'm going to do now is go through some of the areas that do tend to benefit from rising inflation particularly in their particular sectors such as gold, energy prices, agriculture resources, and as I mentioned before, banks and hybrids. So let's start with the first one, gold. What I've got there is a chart of the relative performance of, so MNRS is our gold miners. It's the index that our global gold miners ETF, MNRS, tracks. So it's an index of global gold miners, excluding Australia. And I've got the gold price there in grey as well. And so that's, again, that's a relative performance index. So if that orange line is rising, it means that the miners ETF, gold miners ETF, is outperforming global markets. And as you can see, there is a broadly positive relationship there. So in the earlier last decade, when we had a big upturn in gold prices, miners were generally outperforming the market. Then when gold came back, you saw that miners tended to underperform. And really midway since gold's been a little bit choppy of late. It had a good rally in the initial part of COVID during the downturn last year. And as you can see, gold miners had a very strong period of outperformance earlier last year during the COVID lockdowns. Gold has since come back, as has miners, but gold is in the more recent months has actually started to pick up again. So if you're bullish on gold, I mean, there's two ways to play it. You can buy a gold bullion ETF, of which we have one, or you can buy global gold miners as an ETF, again, which tends to give you an amplified return. So if gold goes up, 5% or 10%, gold miners tends to go up by somewhat more than that. So and in fact, I can share with you that MNRS only last month went up 10%, almost 11% in price performance. Though it's, again, over the year, it's only been up 12% so far because it did have that period of weakness up until recently. So again, if you're bullish on gold, if you just go to the next slide there, sorry. So that's the gold miners ETF that we have. As you can see, it excludes Australian gold miners, so it gives you that diversification outside of Australia. But essentially, it's the leading gold producing companies around the world, all wrapped up in one ETF. MNRS being the code. If you go to the next slide there, the other way to play gold, of course, as I mentioned, was gold bullion. So this is an ETF that actually invests in gold bullion bars that are deposited at a bank in London. So very straightforward exposure to physical gold bullion bars. So if you like gold bullion, you don't necessarily have to go and buy it yourself and put it under the bed. You can just go and buy this ETF, and we effectively hold the gold on your behalf. And that's in US dollars as well, which we think is important because, again, if you're going to play gold and you've got a view, gold trades in US dollars. So people look at the US dollar gold price. And so if you're taking a view on the US dollar gold price, you might as well get US dollar gold exposure through an ETF. If you say take something that's currency unhedged, then you've got to account for the Aussie dollar as well. So if for example, you buy an unhedged gold exposure and the Aussie dollar also appreciates, if we are in a commodity boom and the Aussie dollar appreciates, your returns from an unhedged gold position will be undermined by the rising Aussie dollar. So this gives you a purer exposure to the US dollar gold price. Moving right along, energy producers. So fuel, FUEL, is the ticker code for this ETF. And this is, again, in the same way the previous one was top global gold producing companies. These are the top energy producers around the world. And what I've got there is, again, the relative performance versus global markets in orange with the oil price, the WTI futures oil price. And again, broadly positive relationship. When oil is rallying, oil companies tend to do well, energy companies tend to do well, and vice versa. And as you can see, with the rebound in oil since midway through last year, since the bottoming of the COVID crisis, we've had some rise in it doesn't look that big a rise, but it's been a pretty decent rise nonetheless in terms of fuel producers. In fact, I'll just give you some numbers. So over the past year, it's up 26%. So it's, as you can see, on a year-on-year basis, it's broadly matched the market. Over the past month, it's up 4%. Over the past 3 months, in fact, over the past 6 months, it's up 25%. So, depending on your time period, but it's definitely, as you can see, it's definitely tending to outperform global markets at the moment in an environment where the oil price is rising. And again, so if the oil price keeps rising, you would this is one that should typically do quite well and outperform within global markets. So just give you some information on that one. So again, here's some more information on the specific ETF, the country exposures, the range of different sectors within that. But as you can see, half the index is basically integrated oil and gas companies. There's some storage and transportation companies in there, but in the main, we're looking at the top global producers there. I mean, ExxonMobil, Chevron, BP, Royal Dutch Shell. I mean, the sort of names you would expect to be in such an ETF, essentially. So that's fuel and the oil price. I don't have a slide, but I should point out we also do have a fuel ETF. So if you do want to have a view on the future, I know I stress this is not the spot price of oil. It is the futures price of oil, which doesn't necessarily track the spot price, on a one-to-one basis, as we saw last year, but it does track the futures price. And so if you do want to take a view on the futures price of oil or the current next contract, you can invest in OOO, which is the ticker code for that ETF. But again, you can also invest in companies, and again, if you have a view on, and the beauty of companies also, you do getting some dividend, and you're getting even an environment where oil, and again, I make this point about both oil and actually a lot of these exposures. The other point about these, if oil and gold stay at high prices but don't rise a lot further, so say for example oil goes sideways at a high level, then these companies are still going to be generating good profits at high price. So the beauty about investing in a company, as distinct from the commodity price itself, is that you don't need to continually rely on the price moving ever higher. Provided it stays at a high level, it can generate good profits for gold producers and for oil producers. So I just point that out. So another one is food. So again, this is the same sort of story here in terms of the way I've structured this chart. So food is the ticker, and these are the top global food producing companies. And so we have an ETF that gives you exposure to those companies globally, and the ticker code there is FOOD, food. And so again, it's the relative performance of food producers versus the global market. Against it's an index of agricultural commodity prices, essentially. And as you can see, broad positive relationship as well. There's been a long period from earlier last decade, from around 2012 or so, where there's been a gradual decline in agricultural prices, and so food producers have tended to underperform vis-a-vis global markets. But again, as you can see from this chart, there's been a really strong rebound in ag prices over the past year. And as a result, we've had the food index and the food ETF also perform quite strongly. So again, over the past year, this ETF is already up 54%, 54% versus global markets up 38%. And in fact, over the past 6 months alone, it's up 25%. So again, another one, depending on your view on food prices. I mean, we like this as a long-term. A lot of these are good long-term thematics as well. Food. We're always going to rising global population, rising living standards, income levels in emerging markets, demand for food, particularly processed food, is going to be rising, and so that's going to continue. It should continue to underpin that as a long-term investment. But I just point that out that it's had a pretty strong rebound with the V-shaped recovery in the global economy over recent months. And just some more information on the food ETF there. And again, just a broad global range of companies, as you might expect: Tyson Foods, Deere & Co. So packaged food producers, agricultural producers, all involved there. Miners. So this is an Australian exposure. So QRE is our Australian Resources ETF. So again, it gives you exposure to the S&P ASX 200 Resources Index, so the top Australian mining companies, essentially. And again, this is the relative performance to the Australian market. And what I've got there is the iron ore price. And again, as you would expect, a broadly positive relationship there. When iron ore prices are rising, Australian mining companies tend to outperform in our market. And as you can see, there's been particularly over the past year, a very strong upturn in iron ore prices. In fact, iron ore prices have recently hit $200 a tonne. What's been surprising, in fact, miners have been doing okay, but relative, I mean, they haven't been shooting the lights out. So I guess partly what we're seeing there is the market doesn't believe that these iron ore prices are going to stay as high as they are. They're probably going to come back somewhat, but I would point out, even if they do come back, but even if they stay, in the $100 range, miners are going to be producing pretty good money at those levels, because obviously their cost of production is a lot lower than that. But just to put some numbers on it, so QRE, our resources company ETF, is up 30% over the past year versus the market up 28%. So it really, it's only broadly performed in line with the market. It's done a little bit better on a 6-month basis, up 18% versus the market's 12%. Last month was only up 1.3%, up 5.5% in the previous month. So look, it's been doing well, but funnily enough, despite the very, very strong rise in iron ore prices, resources haven't been doing as well as you might expect, and there's probably some value, still to be found there in the Australian mining sector, given the very high level of iron ore prices. Moving right along. So that's more information on QRE again. So I know many Australian investors, they do own it. You can own individual stocks, of course, and I'm sure many of you have portfolios with BHP and Rio and whatnot in there. But again, if you do want broad, diversified exposure to that sector and not have to juggle multiple individual company holdings and all the paperwork associated with that, this is just a very easy way to get sector exposure through the one ETF QRE. And as you can see, BHP, Rio, Fortescue, Woodside Petroleum, Newcrest Mining, all figure prominently in this ETF. Global banks, and I did mention this earlier. So this is the performance of BNKS. So this is our global banks ETF versus, in this case, US 10-year bond yields. And as I mentioned, the banks tend to do best in a rising bond yield environment. And so we've, unfortunately for banks, since over recent years, recent decades, we've had a trend decline in bond yields, so their margins have been under downward pressure. So you can see banks have generally underperformed the global market. But in periods where bond yields have risen, they've gone through periods of outperformance, and the past year has been no exception. And in fact, irrespective of the inflation outlook, I think we are going to see a broad trend higher in bond yields over the next few years as central banks gradually start to retighten policy, move away from a zero interest rate policy, which does bode well for restoration of margins in the global banking sector. And so this one is, again, just to give you some numbers, this is up 54% on an outright basis over the past year. So very strong performance of BNKS already, up 31% in the past 6 months. Last month alone was up 5%. So again, in a rising bond yield environment, and bond yields have actually steadied off in the last couple of months, but I think the trend again over the next few years at least will be that bond yields will start to move higher, and this is one exposure that is well placed to perform in that environment. And again, some more information there. Again, a broad range of global exposures there. Bank of America, JP Morgan, Wells Fargo, Citigroup. A lot of major US banks in there, but some non-US banks, European, Canadian, Asian banks as well. That's BNKS. The last one, I think, just to highlight, is hybrids, and this is an income exposure. And again, we have now 2 ways to give you exposure to hybrids in Australia: our actively managed HBRD fund and our recently released passively managed a major bank hybrid fund, BHYB, and that just gives you just a passive exposure to the hybrids of the top 4 banks in Australia. Now, the reason I've got hybrids here is that it's an income type of investment. It does give you attractive income. It does give you downside protection versus equity market sell-offs. As you can see on the next slide, hybrids do tend to weaken when equities sell off, but sorry, go back to the previous slide, but nowhere near what the banking equities do. So it is a defensive yield. Now, but unlike fixed rate bonds, in a rising interest rate environment where fixed rate bonds tend to be hurt by rising bond yields, the hybrids are what's called a floating rate exposure. So the yield that you get is the cash rate effectively, plus a credit margin above, which doesn't move in line with bond yields. It moves in line with perceptions of the economy. But basically that yield will stay pretty steady provided the RBA isn't moving interest rates. But as the RBA gradually eventually moves interest rates higher, the interest rate that those hybrids will offer will increase in line with the RBA cash rate, and it won't move in line with shifts in bond yields. So again, because it's a floating rate exposure, its price is not as sensitive, negatively affected by rising bond yields. So it's an interesting defensive income exposure in an environment where fears of inflation, fear of rising bond yields are with us. So that's I think as a defensive income exposure in this type of environment beyond say fixed rate bonds. Now, and that's a bit more information on our recently released a major bank hybrid. Again, many of you may well own individual hybrids. It's been a popular retail investment. I guess the beauty of this is that you don't have to worry about messing around with individual hybrid securities. You can just buy a diversified portfolio of a whole bunch of them. Pays monthly income. The franking credits that the hybrids generate are passed through to investors, so you get all the benefits of the franking credits and whatnot as well. So that's BHYB, and again, we do have an actively managed fund that tries to beat a passively managed index of hybrid over time, which is HBRD, which has been around a longer period of time and has also proven incredibly popular. It's over $1 billion fund now, that one ETF alone. This one is a more recent addition. Look, that's, I think I'm just going to conclude with some growth exposure. So I've talked a lot about inflation. I've talked a lot about ways to benefit, areas that will benefit inflation picks up. Now, just for the sake of completeness, if it is the case that inflation doesn't pick up, or the increase that we're seeing is fairly temporary, and we see inflation start to come back down in the second half of the year, as many think, and some of the growth exposures that have been hurt in this environment come back to the fore, then there's a range of different ways to play growth as well. So I just would highlight that, depending on the inflation story, I wouldn't give up on the growth exposures. And particularly something like NASDAQ, for example, you're talking about companies that do have strong earnings capacity already. These aren't companies that have distant future earnings potential, which do get hurt in a rising interest rate environment. They actually have solid earnings and pricing power. So even in a rising inflation, rising interest rate environment, it wouldn't surprise me if something like the NASDAQ also continued to do pretty well, provided the economy did well. But some of these other areas as well, again, in the interest of time, I won't go through them, but cybersecurity, Asian technology, global robotics, even our own Australian technology exposure, ATEC. These are areas which, if growth does come back to the fore and does start to outperform, then these are different ways to play that growth thematic as well. So I think that's that. Again, I just want to apologise for the technical hiccup that we had earlier. We've gone a little bit longer than we would have ordinarily done, but hopefully many of you have stuck around and listened, and we're happy to take some questions, I think, if that's okay.
Excellent. Well, thank you very much, David, for going through that. And again, we apologise for, I guess, that little bit of delay in David being able to hear everyone online today. So we did have a number of questions that came through, and thank you so much for passing those on. Just looking at the first one here. This is a good one. Right. So you mentioned in the real estate, I guess, performs well in an inflationary environment. The question here is, given that the real estate, I guess, sector has really performed or benefited from ultra low interest rates, how does that work into that narrative of increasing interest rates where they perform?
Real estate, well, I'm not sure that real estate necessarily. I mean, look, it's mixed for real estate. I mean, I didn't talk a lot about real estate. I think there was one slide that had a little bit of real estate in there, but in a rising inflation environment, obviously property prices may well go up in line with inflation, but the problem is that if interest rates also go up, then the discount that you apply to property, the sort of, the capitalization rate as it's called, also goes up. And so the value, basically property effectively is the present value of the future rents that you can generate from that property. That's hence its value. And so if you have to discount those future rents at a higher rate because bond yields have gone up, then the present value can go down. So funnily enough, it has mixed implications. So although prices may benefit from inflation going up, commercial property per se may not be one of the areas to most benefit because it's going to have that headwind of interest rates going higher. So I don't want to. I wouldn't necessarily put real estate in that category of things that are going to do the best in a rising inflation environment.
Okay, excellent. Thank you for that, David. But we've got one question just in relation to, there's a couple in relation to OOO, the oil ETF, and also fuel. Just obviously noting the key differences there, which I think you covered in terms of one is tracking that forward futures contract of oil, and one is actually providing you a diversified exposure of the underlying companies within that particular sector. There is one question there which I can probably answer around the correlation between those two. Typically fuel, which is the one that's giving you that diversified exposure across those global oil manufacturers and producers, it's around about 58-60% in terms of the correlation of the underlying WTI oil price. And that's going back to 2006, since inception up to February this year. So that's what you're looking at in terms of correlation and with that exposure. There's another one here, David, just in relation to comparing MNRS to GDX. Do you want to cover that?
I'm happy to let you get some more specific product related question.
Well,
you're a real expert in that area.
So look, that one there, in terms of GDX and MNRS, what you're getting there, the key difference is obviously the first part is GDX is unhedged. MNRS is a hedged exposure. The other part to that too is with GDX, you are getting both Australian and international global mining companies, where our one is just all international. Why that is, we looked at that, and again, what David sort of mentioned, a lot of Aussie investors tend to already own those mining type of stocks. So it's giving you probably a little bit, I guess, more diversification because you're not doubling up on the companies that you probably already hold through ASX exposures or directly.
Can I just add, I mean, that currency hedging thing I think is also important because hedging the currency basically means you're focusing your bet on the idea that these companies are going to outperform the global markets or do well. If you have it on an unhedged basis, you're making two bets then, on what's going to happen to the currency. And if you really believe we're in a commodity bull environment, then the Aussie dollar would actually appreciate in that environment. So your returns from an unhedged will be hurt by that. So just bear that in mind. Deciding about hedge versus unhedged.
Right, I'm very conscious of everyone's time, and I know that we've gone a bit long today. But just one more for you, David. If interest rates are going to stay at low levels, as indicated by the RBA, circa 2022, 2023, then do you think growth stocks will be in a good option for a portfolio over value stocks?
Look, over the longer run, I mean, I think that's probably true. I think that is true. So I actually, as I said before, I did include growth there at the end. So it is debatable, how much this inflation story that we're seeing is going to persist. There is an argument that a lot of it has been sort of short-run supply-side bottlenecks, and maybe it will start to taper off. And if it does mean that's the case, and central banks don't bring forward their tightening and actually keep rates on hold for several years, then again later this year, you may well see those growth exposures start to outperform again, and I think and particularly again many people look at the performance of technology and compare it to the dot-com bubble 20 years ago, but it's a very different situation today. The major companies in the growth area, the major tech companies are very successful companies with already strong profitability. which is a big difference from what we saw 20 years ago during the dot-com bubble. But yeah, so definitely don't give up on growth. But again, if you have a view of inflation staying higher, I just wanted to highlight those various exposures that are available and are probably likely to at least continue to do well over the next 3 to 6 months, depending on how long these inflation concerns persist in the markets.
Excellent, thank you, David. Look, I think we probably can have one more. We've still got a heap of people still online. Just in terms of hybrids, you mentioned at the end of the sort of presentation there and the two options. Now, what I guess are those key differences, and what would an investor sort of take into that consideration when choosing either the active or the passive option?
Yeah, so the HBRD fund, which was our initial fund here, is basically, it's more, what we term more of a capital structure type product. So in the main, it does invest in hybrids, but it can invest, it can go to cash, for example, if it thought that the hybrid sector was very, very overvalued, expensive, heaven forbid it thought there were some sort of financial vulnerabilities in the banking sector, it could actually reduce its exposure to hybrids and invest in more traditional corporate bonds or cash. And the other element, it does try to play relative value. So picking one hybrid arguably better value than another hybrid, and if their values converge, so one does better than the other because it's cheaper, seen as relatively cheaper, it can generate some added return from that. So that's the active market, and there is an argument to say that a good skilled manager in the hybrids market, given that it is a very opaque market, and many retail investors invest in a good skilled professional manager, may well be able to generate some alpha in that area, and our manager who runs that Coolabah Capital has actually been able to generate some pretty good returns over time through that approach. But the passive one, by contrast, just invests in the hybrids of the major 4 banks. So you're going to get pure hybrid exposure, no active overlay in going into cash at different times. And the benefit of that is, if that's what you want, if you want pure hybrid exposure, without worrying what the active manager may do, it delivers that. And obviously it delivers that at a somewhat cheaper fee as well. Do you have the differences there, the price? It's yeah, so it's slightly, it's somewhat cheaper. I think 20 basis points or something like that. Yeah. So again, being passive, you can get that exposure at a somewhat cheaper price, a lower MER, as it's called.
Yeah, it's 35 basis points for the passive one.
Yeah, 35. Yeah, so 0.35% for the passive, and I think it's 0.55 for the active. Yeah.
Excellent. Well, I think that will be enough for questions. Thank you so much, David, for joining us, and thank you for everyone that attended today. Just things to consider before jumping offline there is obviously investment risk. Portfolio values can go up and down, obviously to a number of different factors. There's no guarantees in terms of future returns are uncertain. And again, as sort of mentioned at the start, any information today was very much general in nature. It doesn't take into account any of your personal circumstances. And as always, do seek professional advice if you are looking for a bit more detail and I guess guidance on how to invest. But again, thank you so much. Again, we will be sending out a clearer recording of this as well, just to highlight that as so that bit that you may have missed at the start with David, that will be coming out in that recorded version, which will be coming out later on today or early tomorrow. Apart from that, enjoy the rest of your Thursday. Thanks for coming and attending today. And if there's any other questions, we do have, as I said, a lot of information on our website. There's a general line there. Please do call through if you want to speak to someone. But thank you so much.
No worries. See you next time.